You clicked this video because your portfolios are full of bad investments. You know they are dragging down your returns, but the fear of selling them at a loss or triggering a massive tax bill has paralyzed you into inaction. This creates what I call a zombie portfolio that silently consumes your future wealth while you wait for permission to move on. By the end of this minute and a half, you will have a specific psychological reset strategy that turns migration from a technical nightmare into a disciplined financial victory without triggering immediate tax disasters or behavioral panic. Let us start with the reality of how brokerage transfers work today. The system used by almost every major broker to move accounts is called ACATS, which according to data from the Securities and Exchange Commission, this process can technically execute a transfer between multiple different institutions within 6 days if your account types and ownership details match perfectly. Here is the catch that keeps investors awake at night. The system treats every asset as binary data. It does not care whether you hold high-quality index funds or speculative junk stocks. The ACATS protocol moves whatever sits in those accounts without validating quality, meaning you can successfully transfer a portfolio full of underperforming assets to a new broker before you ever sell them. This creates a dangerous window where the psychological weight of holding bad investments is transferred along with the data, forcing you to confront the reality that your current strategy has failed while still trapped in the same environment. The biggest misconception investors have is that they can simply swap out their holdings for Boglehead-style index funds immediately upon arrival and expect a smooth transition. This approach ignores two critical factors: tax efficiency and behavioral discipline. If you hold these underperforming assets inside an individual retirement account or a 401k, selling them to buy new ones is generally tax-free because the transaction occurs within a sheltered environment. You can wash away your mistakes without triggering a capital gains event that reduces your compounding power for years to come. However, if you hold these same bad assets in a taxable brokerage account, liquidating them triggers an immediate realization of losses or gains. This creates a complex tax scenario where selling high-cost basis losers might actually save you money through loss harvesting, but doing so recklessly could trigger unwanted taxes on winners that were holding the portfolio together. Quick resource note: I keep a curated set of Amazon search links in the description for books, gear, and tools relevant to this channel's topics. Some are affiliate links, so I may earn a commission at no extra cost to you. Please consider supporting the channel by using those links if you find something useful. Because of this complexity, treating migration as a single event is often a recipe for disaster. The most effective strategy involves viewing the entire process not as a technical swap but as a psychological reset. Before you initiate any transfer or sell anything, you must perform what I call a burning platform step. This requires sitting down and explicitly documenting every emotional and financial reason why you held onto these specific bad assets in the first place. You need to write down that fear of realizing losses kept you stuck for years, or how overconfidence led you to buy individual stocks instead of broad funds. Without this deliberate commitment anchored in behavioral awareness, any new portfolio will eventually drift back toward old habits because the underlying psychological triggers remain unaddressed. Once you have completed this mental audit and are ready to move, do not attempt a big bang swap where you liquidate everything overnight. This approach ignores the sunk cost fallacy that causes investors to abandon migration halfway through when they see their portfolio value fluctuate during the transition. Instead, execute your clean-out as a phased automated sweep over several weeks. Sell 10% of your underperforming assets each week rather than trying to clear the entire mess in one day. This gradual reduction mitigates behavioral panic because you do not have to stare at a massive drop in account value all at once. It allows you to adjust to the new reality slowly while maintaining the discipline required to stick with the plan until every single bad asset is gone and replaced by your target allocation. You also need to be aware of technical friction points that can derail this entire psychological reset if left unaddressed. A common issue arises when ownership structures do not match perfectly between accounts, such as having a joint account at one broker trying to transfer into an individual account at another. These mismatches often cause significant delays in the ACATS process, extending the migration timeline by weeks or even months. During this extended window of administrative limbo, market volatility can induce panic selling of your remaining assets at exactly the worst possible time. This is why a pre-migration audit of all account titles and ownership structures is non-negotiable before you click that transfer button. Ensuring these details align perfectly protects your timeline and prevents external factors from forcing bad decisions when you are trying to execute a clean mental break. The ultimate insight here is that the ACATS system itself acts as an agnostic conduit for both good and bad data, making it impossible for technology alone to solve your problem. The transfer mechanism validates nothing about asset quality. It simply moves binary records from one database to another. This means you cannot rely on a new broker or a faster transfer speed to fix your investment strategy. The real work happens in the decisions you make before and during that 6-day window, where tax efficiency dictates whether you sell losers now for immediate relief or hold them if they are sheltered. And behavioral discipline determines whether you execute a slow-phased sweep or panic into a hasty liquidation. By treating this migration as a deliberate psychological reset rather than just a technical transfer, you break the cycle of holding on to zombie assets that drain your future returns. You move from being paralyzed by fear to executing a structured plan that respects both tax laws and human psychology. This approach ensures that when the dust settles, you are not just in a new account with different tickers, but have fundamentally changed how you interact with money and risk for good. Thanks for watching all the way to the end. I am a one-person team working hard to make each video better than the last. Subscribe if you found value. It is the best way to show support. Drop a comment with your biggest takeaway. See you in the next video.